I still think they're behind the curve, way behind the curve. We should have started ending the taper way last year. We should have started raising rates last year. I thought this was a very bad inflation number. Now, the reason why the stock market reacted slightly positive, it wasn't at the tail end of, my goodness, 3/4 above expectations. But if you look at the details, they weren't good. We had a minus 0.4% energy price decline. Well, that's when oil was down in the 60s. Well, oil is 82. Oil is now within $2 of its post-pandemic high. So it's going to be up when we get those January figures. And if you take a look at the details throughout that, you see that it doesn't look to me like inflation has peaked. I think we're going to have another year of 7% inflation like we did in 2021.
So what does the Fed need to do to get ahead of the curve? And will an aggressive catch-up play mean bad news for the stock market?
Well, I think they're going to have to be far more aggressive. Now, I think Goldman Sachs called for 4 increases, which, brings it to 1%. Very honestly, I think we need to bring that rate up to 2%. Now, people say, oh my goodness, the stock market will fall apart. But one has to realize that stocks are real assets. They're claims on real capital, which means that there's an expression I know you people and we've been using called TINA, T-I-N-A. There is no alternative. Where are you going to go in an inflationary environment? You're not going to go to the Dow, or you're not going to go to cash. You're not going to go to bonds. Stocks are claims on real assets. So my feeling is there are going to be a lot of bumps on the road. And when the Fed has to tighten more, you're going to see some drops. But I still think it could be an up year for Wall Street in 2022, despite that. But the Fed has to be more aggressive.